On Friday, October 10th, Japan time, we saw the cryptocurrency market crash and lose $885 billion in a massive liquidation spike that is literally historic. One day, 16.7 billion longs liquidated across multiple exchanges. This video is not an I told you so video at all. And the reality is that some of you still want to use futures, but I need to share something with you so that way you are protected, so that way you have control over your positions and that you don't get liquidated again. All of that and more here on More Coin Bureau. What's up? My name is Aaron Dishner from The Better Traders, and I'm also posting twice a week on the Coin Bureau trading channel. There are links to sign up for that below, but make sure that you subscribe to this channel first. Now, there are lots of different exchanges and platforms to check out, whether it's Femex, whether it's BYDFi or 2bit. There are way more that are available on the Coin Bureau deals page. You've seen us talk about these. You've seen me talk about these before. But what I want to actually show you is the one thing that will literally help you not to get liquidated, as in your entire portfolio. And it's a simple switch that unfortunately too many people have ignored. Here on Femex, it's embedded or hidden somewhere in this crazy thing. And the reality is that whether you're on Femex or you're on BYDFi or you're on 2bit, all of them have the same button. But for the novice futures trader, you're probably wondering, okay, wait, where is it? What am I supposed to click? Because the default setting for all these exchanges, and this is in no way intended to throw any shade at exchanges, but the default setting is cross leverage. Cross leverage differs vastly from isolated leverage. Here on Femex, you can see the default is crossed, and it's a very, very, very small button. I'd have to zoom in a lot more so you can even see it, and even there, it's hidden. Here on BYDFi, it's also over here. It says cross 10x. And 2bit, it also says cross, where you can choose cross or isolated. And this is a lot of text. And I'm pretty sure a lot of you just go, okay, whatever. The exchange decides to use cross. That's just what I'll use. Awesome. We need to go back over here because I really need to help you understand the risks and the benefits of both cross and isolated margin. So let's do this. First off, let's draw. Drew. It already happened, guys. It already happened. We have two boxes here. One of these is, I have to do it this way, don't I? I hate this part. There we go. This one is going to be our cross leverage. This one's going to be our isolated leverage. Now, the mystery is in the name. Isolated meaning that it is isolated. You are focusing on a specific amount with isolated leverage. Cross leverage, you are leveraging your entire portfolio. What does that mean? First off, the whole concept of leverage trading is quite simple. The idea that you want to use $100, or rather 100 USDT, and you want to give that to an exchange, and you want to use 10x leverage, which is a decent amount of leverage. And then that's going to give you the ability to have a position worth 1,000 USDT. The thing that a lot of people don't consider with leverage is that if your loss equals your margin, then you're going to get a margin call from the exchange saying, thanks for playing. Then they're going to take your $100 and they're going to forcefully close the position. So if it's a short position where you are selling, hopefully, or rather hoping to buy lower, but the price actually goes, nope, it goes higher. Then when your loss equals your margin, then you are done with that position. Game over. Your money is lost. You've given it to the exchange. If you're going long, you're hoping to turn $1,000 into $10,000, and you're hoping that it's going to go up to the right forever. But unfortunately, we know all too often in crypto that is rarely the case, where things really go where we want it to go. And sometimes the price is going to go against us. And when our loss below our entry equals our margin, then we get liquidated. Now, the obvious safety net that we can use is a stop loss. A stop loss is going to have a fixed limit order at a set price. So if we're going to be going long, price goes up, and we really like how we're feeling, but we decide, you know what, I really want to put a stop loss here just in case the price goes against me, and lo and behold, it doesn't hit my target. It comes down here. Well, it gets stopped out in profit. Stop losses do not always mean that you're going to be losing money. The way that most people think of stop losses is that stop losses are below your price, which can be the case. I've been stopped out many times below my entry, and you get stopped out at a loss. This is normal. But stop losses can also be put in a profitable position to protect your profit. So don't think that stop losses are terrible, but there's a difference. If I am not using a stop loss, I have a long entry, I'm expecting the price to go up a lot higher, but let's say that it doesn't. There's a scam wick. Price goes really far down, really fast, like we saw on Friday, the 10th or 11th of October, depending on your time zone. And then our loss equals our margin. Well, then we get basically a margin call. But if we are using cross leverage, that means that, let's say out of this $100, it's actually not our full position. Let's say that our total portfolio size is actually 10,000 USDT. So our port size is actually a lot bigger than the amount that we're trading with, which honestly, this is how a lot of responsible traders function. You open up a position with a percentage, in this case, 1% of your portfolio size, but you leverage it, so it's really 10%. But that's besides the point. So even if with cross leverage, you're down here and you reach this area where your loss equals your margin, guess what? The price can just keep going lower and lower and lower. So why is this a bad thing? Isn't this a great thing? Because you would have been liquidated at a loss of negative 10% for your position here. Why is this a bad thing? Well, as a lot of you found out on Friday, again, with that massive liquidation, the problem with cross leverage is that it's not just an isolated amount of your portfolio. In this previous example, this is isolated leverage. I have a portfolio of $10,000. I'm going to use 1% of it, and I'm going to use isolated leverage on this full position size. So if the price happens to fall down 10%, then I get liquidated. The goal, I just want to make this super clear, is never to be liquidated. Being liquidated is not a badge of honor. It's not a nose piercing. It's not a face tattoo. You're not cool because you get liquidated. It's a waste of money. It is poor capital management. I do not say this to rub salt in the wound, to add insult to injury, but that's the truth. Getting liquidated is not the goal. Also, getting a 1 millionx on 150x leverage is also not the goal either. But that's besides the point. So going back to this idea of isolated leverage, if I don't have a stop loss in place, the price goes against me and I get stopped out. Actually, I don't get stopped out. I get liquidated at 10%. Boom, done. That's it. Actually, it's going to be a little bit more, or actually a little bit tighter, more like 9.6%. Then I'm liquidated, done. So the exchange says, thanks for playing. They take this and it goes bye-bye, and I don't have those funds anymore. But with isolated leverage, even though I have lost $100, the reality is that I still have the rest of my portfolio to play with. I still have $100 less. So $9,900 USDT to play with. So my portfolio size has not been affected because it hasn't been exposed. But if I'm using cross leverage, this is where a lot of the liquidation cascades happened, because as we know, we didn't see prices go down just 10%. We saw some prices going down really far. Some charts going down 56%, some of them going down 80% in a single wick. What happens then if you're using cross leverage, meaning that your entire portfolio is up for grabs? Well, ladies and gentlemen, the unfortunate truth is that If you have a portfolio size of 10,000 USDT and you're still using proper risk management, which this isn't in a way, but you're using just 1% of it and you're leveraging it by 10x, and we go down 10%, but the price just keeps on dipping and dipping and dipping and dipping. Eventually, what is going to happen is that as the price goes lower, your risk increases, you see more pain, more fear, you get more anxious, and what happens is that it's no longer $100 that's your margin. Guess what? Your margin now becomes your portfolio. Cross-leverage does give you the flexibility of using your entire portfolio as collateral, but that means your entire portfolio is collateral. That means that if your loss equals $10,000, then the exchange now says, thanks for playing. That's it. And not only is your margin gone, but so is your portfolio because of cross-leverage. Are there moments where cross-leverage is helpful? Yes. There are moments where cross-leverage is helpful when you're using a ridiculously small percentage, but you're still always exposing your entire portfolio. Now, what about sub-accounts? Some exchanges allow you to have multiple accounts under the same umbrella. So you could have like 2bit 1, 2, 3, 4, whatever the exchange is. Bybit does this as well. And I use this. Now, using a sub-account does protect you to a degree, but it depends on how the exchange views the sub-accounts. If the exchange says, well, yeah, you can devalue your funds up, but if one of those sub-accounts gets a margin call and you have cross-leverage, then it's going to draw from the other available funds. You have to read the fine print. So what do you do? Well, for me, I do use cross-leverage, but that means that I have to use a stop loss. And if I use isolated, guess what? I'm using a stop loss. The unfortunate truth is that too many people think that they're Superman because they've seen some insane profits when markets are super bullish or bearish, because that's the benefit of leverage. And that's actually the intended original purpose for leverage trading, is to use it as a hedge against a falling market like we're currently seeing right now. Currently, the price of BTC is falling. So the benefit of opening up a short position is that as the price goes lower, well, guess what? You can hedge your position. You don't have to sell your Bitcoin. You can hold on to them. And as the price goes against your portfolio's worth, you're actually going to be making money as the price goes down. That is the intended use of leverage. The unfortunate truth, though, as all of us know, is that many traders decide not just to use, even 10x is a lot for some people, even a conservative 3x. It doesn't matter. 2x leverage, it doesn't matter. If there is another massive wipeout, even with safe leverage, if you're using cross margin, you are exposing your entire portfolio. Now, there might be strategies that require you to use cross margin. Okay, cool. That's fine. But for most people that are dabbling with leverage, if you really want to use leverage, which is fine, you can use whatever you want, but you have to understand the difference between using cross and isolated. So where at all possible, I do recommend that you use isolated leverage. I also recommend that you spend a little bit of time figuring out what your liquidation prices are, because sometimes exchanges don't make it plain and simple and easy to see. But I will say this, and this actually helped me a lot when I started to trade with leverage. I actually felt a lot more comfortable after realizing this one fact. An easy thing to remember in terms of leverage and liquidation is that a 10x leverage position does not equal, and I don't know if I can type this. I don't think it's going to work on my keyboard. I can't find it. Nope, it's not going to work. Oh, that's just going to zoom it. Okay, never mind. It does not equal, I'm going to do this. Oh gosh, I just put my Japanese keyboard on, didn't I? I can't remember now. It does not equal negative 10%. It's going to be just a little bit tighter. It's going to be more like negative 9.3% if you're long. But if you are short, it's actually going to be more like 10.5%. There's actually a difference between long and short. So you want to do your research before you open your positions. But for most people, when you're starting out, you don't want to use 10x leverage. That's actually too much. I use it because I'm comfortable with that amount of risk. But for most people, 3x leverage. I know it's not sexy, but I will say for sure, anyone boasting big gains from 100x leverage, they're probably using $1. 150x leverage, you're basically just better off donating your money to a good cause. 10x leverage is where you start to get a little bit crazy. And I'm using, again, a small amount of my portfolio. But for most people that are learning about leverage, or if you're really wanting to get back into it, more leverage isn't really the answer. Can you make more with more leverage? Yeah, but you can also lose a whole lot more. Again, like we saw just last week. I'm not against leverage at all, but I'm against people just using a default setting just because, oh, that's what the exchange has given me to do. Then again, I'm not throwing shade to any exchanges, but you have to know the difference between cross and isolated. You have to know what is up or what is at stake when you're using cross leverage. You also should not be defaulting to being liquidated. It's not cool. It's not amazing. You don't get a special letter in the mail from the exchange saying, congratulations, you made it to the liquidation club. Office hours are from 10 to 6, Monday through Friday. Like, that's not how it works. Understand that stop losses may be red, but protecting a position that's already in profit with a stop loss is a big win. I know that there might be some questions that you guys have about this. I have courses at the Better Traders. You don't have to go there. There's also lots of other content that's on the More Coin Bureau channel, as well as the Coin Bureau Trading channel too. But understand that leverage is a way to use a small amount and grow it. You don't necessarily have to do that. You can still use spot and do extremely well. And you can use leverage, but you should use a lot of discretion and consider switching to isolated leverage instead. Now, if you want to go deeper, I want you to watch this video that's going to teach you how to make a little bit more profit in the bear market that I've actually done way back in 2018. Watch this video. Until the next time, you know what to do. Stay awesome and stay in the green. Peace.